Thanks everybody for showing up. Thanks everybody for who's on Zoom. You all know us, obviously, Max Neese, Tim Heisterkamp, and today we're going to be talking about the 1040 form, understanding your 1040 form, and just in general some other tax insights or tips and things to be aware of when it comes to your tax return. So just starting off, what is the 1040 form? We've all seen it before. It is just your individual income tax return. So it's the form that we all file every single year and determine basically, did we pay too much? Did we not pay enough? Do we get a refund or not? Of course, you have to file by tax date. For most people, that's April 15th. For those who file an extension, you get another 6 months, October 15th. And then if you are 65 and older, you do get the ability to file the 1040 senior SR. So again, just for those folks 65 and older. The 1040 form, though, just in general, just kind of our summary page. It has basically 3 sections, and really at the end of the day, it just shows, did I pay too much? Did I not pay enough? And are you getting a refund or not? So this is, of course, what it looks like. So talking about the sections, we got an income section, which is really the most important section of the tax return, the 1040 form. Then we get into our taxes and credits. How much taxes are you really liable to pay? And then here we get into the payments and refundable credits. So how much taxes did I have withheld through the year? How much did I pay in on maybe on a quarterly basis? And then what refundable tax credits am I entitled to? And then that's where it spits out as your total payments. And then we get in here to your to any refund or underpayment that you are required to make. So again, just really it's a form that has 3 sections. The most important, I would say, probably being that income section, but it just kind of summarizes everything very nicely. Any other comments there? So who must file a 1040 form? So if you are somebody under these income thresholds for a single filer, a married filer, or head of household, technically speaking, you're not required to file the 1040 form. So there certainly are folks, I think more so maybe retirees who, if you're under this threshold, people who do not file a tax return. But even if your income is below this, is there a reason to still file your tax return? The answer is yes. If you're somebody who has withheld taxes throughout the year, you should definitely file your tax return to be able to get those overpayments back. And if you're somebody who is entitled to a refundable tax credit, which is something we'll touch on later, but in order to qualify or receive that refundable tax credit, you do need to file the tax return to be able to get that paid back to you. So even though not everybody is required to file, oftentimes it can still make sense for certain people to still file the tax return. So it really, never mind.
So those of you who know me, I've asked you this question maybe several times before. What is the most important line on your 1040 tax return? So I want you to turn to your 1040 tax return right now, or the form that I put in your packet. And if you looked ahead, you'll know, and maybe if you remember from me hollering at you all the time, what is your most important line? It's your taxable income line, which is line 15. You know what? When I ask people what your gross income is, I bet 100% of the time people are within $1,000. They know what their gross income is. But when I ask people what their taxable income is, very few know it. In fact, I'll be honest with you, there's a lot of times I can't remember what my taxable income is from one month to the next. I usually have to go look it up. So it's line 15. So as Max pointed out a little bit ago, there's just certain sections on the tax form that gets us to that taxable income line. So the first section is on page 1, and it's even labeled here. If you look there, it's line 1 through 11, 1 through 11A. That is all your income that you have to report, from W-2 income to Social Security income to IRA income, and the list goes on and on and on. But I do want to point out a couple things there. If you would go down, let's start with Social Security income. Is everybody in this room on Social Security already? It looks like it. So look on line 6A and 6B.
We do not have like the line 15 on here. We don't have the standard deduction, at least on this. Oh, there it is. Never mind.
Yeah. So first of all, line 6A and 6B. So when you get your Social Security, you will put your gross benefits on line 6A. That's right there in smack dab in the middle of the page. And then if you move to the right, it says taxable amount. So not everybody pays tax on Social Security. Some people pay zero tax on their Social Security benefits, and some people will pay tax on up to 85% of your Social Security benefits. But the richest people in the world, or the richest people in the United States, I should say, they only pay tax on 85% of their Social Security benefits. So for every $10,000, they have to claim 8,500 as taxable income. Make sense? And there is a formula, and it's kind of a convoluted formula. I don't even want to go into that formula on how they figure out how much is taxable, but they do. It depends on how much other income that you make. And we always talk about the domino effect. And I talked about this last month, as a matter of fact, is that you have your Social Security benefits and you can calculate it all out and say, I pay this much tax. But let's pretend that you come in and say, well, I went and got a part-time job and I earned about another $10,000. Or let's say you go and take another 10 or 20 or $25,000 out of your IRA that you weren't expecting it to. Well, we always say that the Social Security tax is a domino that gets hit by extra income domino. So you make more money by working, you take more money out of your IRA, and that income domino falls and it hits the Social Security domino, and all of a sudden you're paying more tax on your Social Security benefits if you're not already at the maximum level of 85%. Now, I'll tell you, if you're on IPERS, you're probably already at the 85%. If you have rental income, you're probably at the 85% level already. If you're taking RMDs out of your IRA, big RMDs, you're probably at the 85% already. But it is something to be aware of, is how your Social Security benefits get taxed. So let's go back up to line 4A. Most everybody has an IRA, a 403B, or a 401k. And those distributions get reported on line 4A. And then you move over to line 4B, and they may or may not be taxable. Does anybody remember why your IRA distributions might not be taxable? The qualified charitable distribution, known as the QCD. And if you look just right below there, there's a little box that you can check that says QCD. So if you've taken money out of your IRA and sent it straight to a charity, that is non-taxable to you. So you do not have to declare that as income anymore. So that is a way that you can get money out of that qualified account without paying tax on it. The ever famous QCD. Now, one important thing to remember about QCDs. You have to be 70 and a half years old to be able to do a QCD. If you're not 70 and a half, you do not get to do QCDs. There's capital gains, there's interest income. Of course, if you look at the interest line that you have, that's on line 2A and 2B. If you have municipal bond interest that is tax exempt, you do not have to pay income tax on that for most cases. And you can see the other types of income there. Does anybody have any questions on income at all? I'll let you take a few seconds and peruse that if you like. After we get through income, we want to go through your deductions, and that is over on the next page, on the back page, page 2. So right here, after we get your adjusted gross income established, and by the way, your adjusted gross income is on 2 lines. It actually shows up on line 11A, and then we copy it over again on a line 11B. Every deduction that you get, have you ever heard the term above the line and below the line deduction? If you've heard of the term above the line and below the line deduction, it's like, what line are we talking about? Line 11. With line 11A and 11B. That's the line. So if you get deductions above that line, that is above the line deduction, that decreases your income. And then a below the line deduction, after we figured up your adjusted gross income, you get another deduction, and that is generally your itemized deductions or your standard deductions. So,
And a more favorable deduction is an above the line deduction because so many things are based off of your adjusted gross income as far as how much, if you're able to contribute to this or if you're qualified for this deduction or this credit. So that's why an above the line deduction is more favorable than a below the line deduction.
So let's give some examples of above the line deductions: an IRA contribution, a 401k contribution. If you're eligible for a health savings account, you make a health savings account contribution, you get to deduct that. So there are some certain deductions you can now. Once you hit 65 and you retire, you don't get a lot of those. I mean, these are generally when you're still working type deductions. So anyway, so we get to a line 11B, that's your adjusted gross income. And then finally, we on line 12E is where you get your standard deduction or your itemized deductions. I think we're going to talk about those a little bit more, the exact dollar amount. But finally, you get a few other deductions below the line. And when you get to line 15, that is your taxable income line. That is the actual amount of income that you will pay tax on. And it will be much lower than your gross income.
And we'll get into this later, but when you see the tax rates, that's what the tax rates are based off of. And that's the range when you see your income tax rates. The line 15 is what you'll fit into there to see what marginal tax rate you'll be in.
Yeah, so we'll talk about that. And then on the very next page, we actually have your tax rates for 2026, where you'll be able to kind of plot your adjusted gross income line. So I'm going to encourage you all this year, when you get your taxes done, if you haven't got them done already, but when you get them done, pull that out and go look at line 15 and find out what is my taxable income. And then you can plot it over there and find your effective tax rate. Maxwell, I think that's all I want to say about that.
Next, we're going to dive into the income section, which, Tim just obviously spent a lot of time talking about. The income section is really what drives the overall return, though. So the important part to know is that not all income is taxed the same, or another way to say different income is taxed differently. So depending on where the income shows up on the return or what kind of income it is, will have an effect on how it's taxed. So to kind of just go through the income section, we're just going to go through a little scenario with this couple, John and Jane Doe, a retired married couple, both over the age of 65. And so we wanted to be thorough and just kind of lay out every type of income that might apply to a retiree. So this couple would have interest income, $6,200, qualified dividends from some stocks or ETFs or mutual funds of $9,800. They have total IRA distributions of $102,000 for the year, but we're also going to assume that they have 20,000 of that 102 is going to be a QCD, a qualified charitable distribution. They've got pension income, let's say it's from IPERS of 12,000 a year, total Social Security benefits 38,000. So for this couple with that amount of income, they're going to hit that 85% threshold. So 32,300 is going to be taxable for them. And the only withholding that they've done through the year is withholding 12% on their $82,000 IRA distribution. The rest, they have not withheld any money from. So now let's go to the income section of the tax return and kind of plot everything in. So here, 2B, that's where their taxable interest, so the interest, say, from their CDs or money market, that's where that's going to show up is that section 2B, $6,200. Their dividends, their qualified dividends, section 3A, that's $9,800. So importantly, they don't have any ordinary dividends, but their qualified dividends of $9,800 show up there. For qualified and ordinary, yeah, good question. So a qualified dividend is a dividend paid. It's paid from a qualified stock, which most stocks pay qualified dividends, or most ETFs, exchange traded funds, pay qualified dividends. In ordinary, and they have different tax rates, and Tim will get into that later. But an ordinary dividend would be something that is just taxed at ordinary income tax rates. So something that pays an ordinary dividend, like we have a lot of clients in a money market mutual fund. It pays an ordinary dividend, just like a CD, or some things called master limited partnerships or other kind of unique REITs pay ordinary dividends. So most things that we're familiar with when you invest stocks, most ETFs pay ordinary or qualified dividends, but bond funds, bonds, or not bonds, but bond funds, bond mutual funds, money market funds, things like that will pay ordinary dividends. They are yes, they are taxable, or can be, I should say. They
They can
can
be. It
be.
depends on how much other income you have. So you have your ordinary income tax rates. Remember my yellow sheet? I don't think we put it in there this week, did we? But the yellow sheet that we have, or we'll just look over here on the next page, the
This sheet
2026
should show
tax
that.
planning. You'll see in the upper left-hand graph, you'll see the marginal tax rate goes from 10 to 37%. So that is your ordinary income tax rates. And then if you look just to the right there in the upper right-hand corner, it says taxable income brackets for 2026 long-term capital gains and qualified dividends. And you see those tax rates are 0%, 15, or 20%. And then you go to the right, whether you're married, filing jointly, or a single, and how much income you have to be able to only pay 0%, or how much income you have to pay 15%. So you could be in the 32 or the 35% tax bracket for ordinary income. That's your interest, Social Security, earned income. But you could only have to pay 15% possibly on your qualified dividends. So why are qualified dividends qualified dividends? And you may have heard me say this before, but I'll say it again. When a corporation, pick a corporation, Casey's General Store, pays a dividend, that dividend comes out after they've already paid their corporate income tax. Dividends, qualified dividends, are not a tax deduction to the corporation. It is income that is taxed twice by the federal government. They get taxed at the federal level, and then when they disperse it to you, if you're in the 22% tax bracket or higher, you will pay tax on that again. That is why they qualify, and that is why it gets a lower tax rate than ordinary income, because
Another
that income has already been taxed again.
Yeah, another example, if say somebody has a C corporation, like, any small business technically can be a C corporation. So like I could use my parents, for example, Nice Incorporated is. Uh, a C corporation files its own income tax return as its own entity. But if a C corporation issues money to its shareholders, that comes up as an ordinary dividend that they have to pay tax on. So to Tim's point, the C corp has its own tax return, pays taxes on income, but if they turn around and take some of that income and pay it to the shareholders or the owners then again have to pay tax on that as well too. So it's the double taxation.
Identified on the 1099 box it's in on the 1099. That
Yes.
taxpayer knows what bucket to put that in.
Yep. And so take somebody who has there's a lot of different names for this, but a non-retirement investment account. So a taxable investment account like somebody with us. You'll have interest income, dividend income, both ordinary and qualified. You'll have potentially capital gains, long and short term. So it's a consolidated 1099 because all that shows up on one report, and they divide up what goes to what. So, yeah, Brian. Yeah.
Where do you put on the, when you total all the taxable income, where do you actually put the amount you have to use tax?
Well, it gets a little complicated when it comes to the long-term capital gains and qualified dividends because it's not as simple as saying it's not taxable or taxable right away. You have to look at what your total adjusted gross income is first, or taxable income, I should say, after we get past this section. Look at taxable income, and then a portion of those might be taxed at 0%, and then a portion could be taxed at 15, depending on the situation, or maybe all's taxed at 0 and all's taxed at 15. It just depends on what your taxable income ends up being.
And there are several schedules and attachments that will flow into the 1040 form. So this one will be on Schedule B is where that will show up. So it will not, I don't believe it will show up on the 10.
Until, well, you'd have to get to the tax side. So like here we go, for example, I don't know if we get into it. No, here we go. So here's this couple. They're $9,800 of qualified dividends. Well, I'll
do this. Maybe that answers.
Well, I'll just keep going, Brian, and then we might get your question answered maybe. So this is a software that Tim and I use when we analyze clients' tax returns, and we're doing what if scenarios or just analyzing past returns versus what this next year could look like. So here's the same couple with their total income, with their total deductions, which is the standard deduction plus a few additional for this particular couple, which arrives at that taxable income number of $95,600 in their total tax. So for this couple, what we really like about this is that it shows they are in the 12% marginal tax rate, meaning the next dollar of earnings they have from like an IRA, for example, is going to cost them 12%. But oftentimes what I think is maybe almost more important is looking at your average tax rate. So what is the total tax liability that I paid through the year divided by my total income? That's the average tax rate. So on average, they paid about 7% of tax based off their total income and the total tax that they had, but their marginal is 12%. And in fact, they're right on the threshold if like basically the next $1,000 is going to bump them up to the 22% tax bracket in this particular example. So this report just makes it nice and clean, just shows all the income, qualified dividends of $9,800, and then we have our Social Security. So then we go here, and this just shows where they are at certain thresholds. So for this couple, there's the ordinary income tax rate. So that's money from their IRA and their Social Security. Their qualified dividends don't show up there, but they are close to bumping up in the 22% tax bracket. But here, like maybe your question, Brian, so they are hardly under the threshold. So the taxable income threshold is $96,700, and below that, their qualified dividends are taxed at 0%. If they go up hardly any higher, then some of those are going to be taxed here at 15. But because they're still below that by $1,100, all that $9,800 is taxed at 0%. But as soon as they have a little bit more income, say from the IRA or more qualified dividends, potentially, it might bump them up. So at least a portion of that's going to be taxed at 15. This would be a great example of good tax planning to keep them right. And this is something that we do all the time, or we like to do, and it's easier said than done because you have to make a lot of assumptions. We look at like a 25 return, and then we plug in scenarios for 2026 and say, okay, we're assuming this is going to be this. And a lot of times we have pretty solid numbers, but we have to make some assumptions. But like taking this example where ordinary income is under the 12% threshold, we like to maximize tax brackets. So for somebody who's in the 10% tax bracket, we like to maybe it's taking more money out of the IRA. Maybe it's doing a Roth conversion from the IRA and keep you in the 10% level. Or if you're firmly entrenched in the 12, maybe it's the same thing. It's just filling up the tax buckets to get you just right under that level. We're not bumping up in say the 22 in that example. So yeah, it is definitely a scenario of tax planning. And the same thing applies to qualified dividends and specifically capital gains, which you have more control over. You know, we brought up this example before in a previous seminar, but if we have a client with a huge unrealized capital gain in a stock, for example, and they are in the, say, 10% tax bracket, it probably makes sense to sell that stock. We can turn around and buy it right back, reset our cost basis. But if we can keep them in the 0% tax bracket, by doing so, then that's probably a good thing to do. So
let's talk about the domino. This is another domino. Make a lot of ordinary income.
Oh, yeah.
Zion. If you make a lot of ordinary income, then this is another domino that falls where you may not have been paying tax on qualified dividends, and then all of a sudden you made too much income, and now you are paying tax on qualified dividends.
Yep.
So is it a bad thing? Remember, if you're paying tax, it means you're making money. So we just want to just be tax efficient because, again, I say it over and over again, you always want to be paying tax at the lowest possible rate.
These get so complicated to the point that I don't know how anybody compares taxes to that software.
Correct.
Like
yeah.
Compare has all this. So it automatically calculates all this because it knows what you're, I mean, it's for a human being just to do this on their own is nearly impossible.
Yeah, I remember filling out my first tax form. I did it myself, and it was pretty simple. I took my W-2, teacher income, put it over there, and bam, I was done. It was a piece of cake. Nowadays, it's just, it's too many moving parts.
Yeah, I got a lot of respect for people who were doing this before software was out, because even like this software that we use all the time it just makes things so much simpler. I mean, Tim talks about 10 years ago, actually having the 1040 form and putting everything in and like, okay, if I add an IRA income, what's that going to do down the line? And this is just a click of a button and it just makes it so simple. So
Yeah, way back when I did a lot of this planning with Excel spreadsheets and a calculator. And yeah, this software makes it much, much easier. And by the way, we want to do this for you. So if you have questions on where you're at and can you be more efficient with your taxes, let us help you. This is we actually geek out on stuff like this. We have fun doing that. So
yep. So that's just kind of the scenario with a retired couple with a lot of different sources of income and how that's all taxed, how it flows through the 1040 form. There's kind of a lot there, but it kind of flows through nicely into our Social Security benefit taxation and how that will work for this particular couple. So income taxation of Social Security, we've already talked about it, but not everybody pays tax on Social Security. In fact, the number is about 50% of taxpayers don't pay tax on Social Security. The other 50% do at certain levels. So maybe it's not quite as high, it's like 45%. But for a single person filing your head of household, if you're in the $25,000 to $35,000 range, then you're paying up to 50%, up to, not 50%, but up to 50%, depending on where you are. If you're over 34,000, then you're going to pay up to 85%. But if you're well over 34, then you're at 85%. And let me take a step back. This tax base, Tim brought up earlier, it is a complicated calculation. It's called provisional income. So to arrive at where you are in here, you have to look at what's called provisional income, which looks at your modified adjusted gross income plus tax exempt income. So think like municipal bond income plus half of your Social Security benefit. So you add in, you plug in those numbers. That's where you arrive at this tax base of where you are, and then that's what depends on how much Social Security taxation you're going to be is going to apply to you.
So if you're running through your head right now, you start with 50% of your Social Security benefits for this math,
yep.
And then add in that provisional income.
So if you are somebody with, mostly you have, say, Social Security income, then more than likely you're not going to be taxed on much, if not, or maybe anything at all. But if you're somebody with pensions or interest income, red income, huge IRAs, then more than likely you're going to be on the higher end of this or maybe maxing it out. So this is a very important number or a very important thing, although Tim and I were talking this morning and I looked this up because we knew it hadn't changed in a while, but that tax base income range, believe it or not, has not changed since 1993. So if it looks low, it's because it's not been indexed for inflation for over 30 years. So if it had been indexed for inflation for a married couple, you'd be looking at 110,000-ish of income where you wouldn't be paying. If you were below that, you wouldn't be paying a portion or maybe not at all. But so it's kind of a phantom tax, if you will, just because those ranges have not increased for such a long time. They've stayed static. So back in 1993, only 10% of people paid tax on Social Security, and like I said, now 50% are. So which makes sense just because incomes, of course, have gone up. So that's the calculation. It can be a little bit complicated, but it's just something that we want people to be aware of because not that you can always control it. And if you do have those other sources of income, there's just no getting around it. You're going to be taxed at least 85% of your benefits going to be taxed, the Social Security benefits. But if we can plan around it, we do. So here's a scenario kind of using some of the numbers from that John and Jane Doe example, but this is a scenario where we talk about the tax time bomb or the domino effect of taking more money out of your IRA or having additional income come in and what that does for your Social Security benefits. So this example, we have this couple is taking out $20,000 from their IRA and their Social Security benefits were $38,000. So under the base example, that means their taxable Social Security was $17,900. But now let's say they're going on a vacation and they need another $20,000 out of their IRA. We're doubling that to $40,000. Oh, it should seem pretty simple. I know I'm just going to take more out and I'm in a 12% bracket. I'm going to be taxed at 12%. Well, it's the domino effect here that we have to consider. So what does that additional $20,000 do to my taxable Social Security? Well, it takes it from $17,900 to $32,300 or increases by $14,400. So next thing you know, you have a $20,000 IRA distribution that increases your taxable income by $34,000. So it's not always as simple as I'm going to take money out of my IRA and I know I'm in the 10% bracket or 12% bracket. It's going to cost me 10 or 12. It's always the domino effect that we talk about. Again, if you're in that lower threshold of Social Security, the Social Security tax bracket there. Well, you tell. It's your story to tell.
You've been around me a long. You've heard this story. I had a guy several years ago when the tax rate was actually 15%. He came back from Texas, wanted to increase his park model, came to me and said, I want to take $25,000 out of my IRA. And I said, time out. We need to calculate the tax. And he goes, I already did. It's 15%. I already know exactly what I'm going to pay. But he wasn't paying a whole lot on his Social Security. In fact, he was only paying about $1,000. Only $1,000 of his Social Security benefits were taxable. But as soon as he took out that 25,000, it jumped it up to like $25,000 of taxable Social Security benefits, which is going to increase his tax liability by almost $4,000. So where he thought he was going to pay 15% on 25,000, well, after I did the calculation, I came back and said, okay, plus 4,000 extra tax on your Social Security benefits. So he's glad. He was very, very happy that we slowed him down and he figured out another way to pay for his new park model. But, you know, a lot of people think that they don't understand that domino effect through the tax return. And it's time just to slow down and make sure that you don't, you know, cause some undue taxes. So.
And it's of course not something you can always avoid. It's just something that we want people to be aware of. It's just a little bit of a phantom tax, if you will, that can pop up.
Yeah, it's not. I'm not saying it's not a bad thing. I don't want him not to get a better park model. It's just that he needs to be aware of the extra costs with the way that he wanted to fund it. So, and we'll tell people all the time, it's like, well, maybe you should go borrow money at 5 or 6% rather than pay tax at 22. You know, maybe maybe paying a little bit of interest to the bank is better than paying tax to Uncle Sam. This is a thought.
Certainly helps. Well, advantageous, yeah.
We'll go over and talk about that in a little bit.
Yep. And so, yeah, it does.
My slide. Another domino, and this is just a little side note real quick. It's called IRMA, income related monthly adjustment amounts. And this is for your prescription, or excuse me, your Part B, Medicare Part B premiums and Medicare Part D premiums. And that is if you make too much money, you pay an extra premium. So for 2026, the Part B premium is clear over here on the right. The base premium is $202.90 in the upper right-hand corner there. $202.90 for 2026, and that is for a single filer making less than $109,000 or a joint married couple making $218,000. That's what you'll pay for Part B premiums. But as soon as your income jumps up above the 109 on up to clear up to 500,000 or 700,000, you have to pay a surcharge for the Part B premium. It will go from $81.50 all the way up to $487 per month added to your Part B premium. And Part D surcharges are there. And so you'll see ultimately, instead of paying $202.90, you can pay as high as $689.90. Why is that important to know? A lot of people go, well, I'll never make over 109, or we're married, we'll never make over 218,000. Well, we see it frequently. We'll see it when maybe a farmer wants to get out of farming and they sell a lot of equipment. And they have all that depreciated equipment that they have to recapture and pay income tax on. Or somebody sells 40 acres of land, or for some reason or another, they're selling something big and it jumps their income up. So you have to be aware that your Part B premium is going to go up 2 years after you make the sell. So for 2026, this becomes effective if anybody sold something in 2024. It just takes the government that long because your 2024 transaction happened, but it doesn't show up until you file your 2024 tax return, which happened by April 15th of 2025. The government goes through that by the rest of 2025, and then they ding you in 2026 with this surcharge. So it's always 2 years later. And again, you just may not be able to avoid it because if you want to sell the equipment or sell a piece of an asset that makes you a lot of money and jumps you up, you just have to be prepared for it. I remember, again, another story, the first time I ever came across was a couple who wanted to sell 40 acres of farmland. And they did, and their income was like $400,000 or $500,000 that year. And I said, okay, now in 2 years, you're going to pay extra Part B premium. So we calculated what it'd be up. We squirreled that money away. And then when that money came up, they go, oh yeah, that's right. We have to pay that extra premium. And so they were prepared for it. But again, it's just one of those things that's a domino effect that if that happens to you, you just have to be prepared that it could, that you have to pay. Now, you could inherit money from a parent that has a big IRA that could jump you up. You can inherit maybe an annuity, a non-qualified deferred annuity that all of a sudden you have to start declaring income on. So there's a variety of things that could jack that up. Yes, Nancy. It goes just the next year. So again, so let's say that you had the big transaction in 24, but in 25 you didn't. So you file your 25 tax return by April 15th of 2026. The government looks through there, oh, your income's back down. So then it goes down for 2027. So that surcharge happens for the entire calendar year from January through December. Correct. Yeah. Correct. So again, some tax planning. Let's say that you're selling a business and you go, well, do I take this business all in 1 year or do I sell it on contract over 5 years? You know, you got to figure out what the total liability is going to be if you're selling an asset like a business or a farmland or something like that. Yeah. So because you can drag that out for several years if you sell a business slowly over the course of time and your income gets jacked up for several years, then this is an extra tax that you have to be aware of. You know, especially if you're doing something that caused you to be clear up there at the top end, and that is $578 per person per month. You're a married couple filing jointly, it's this times 2, folks. So it's a cost that you have to be aware of. So
yeah,
yes, I did. Income related monthly adjustment amounts.
Yeah,
IRMA for short. And tell you the truth, I forget what that acronym stands for all the time. Yeah, it's income related monthly, So adjustment amounts. Okay. Okay, so how do you get your income reports? Y'all know this, W-2s, 1099s is how you report your income. The next one, there's several 1099s. And now a lot of times, especially with brokerage accounts that you get from us, like LPL, they'll combine all of these on one big report. So you have your 1099 DIV. You can guess that reports dividends. Your 1099 INT, that of course reports interest. 1099R is your IRA distributions or 401ks or any distribution from a pension. 1099 miscellaneous, 1099. So 1099 miscellaneous would be if you're self-employed or maybe you like contractors. When we did this business here, maybe a contractor required a 1099. So I would supply a 1099 on what I paid them. 1099 NEC, again, independent contractors there. This is really interesting because it only is $600 and above. I remember several years ago, my son was mowing our neighbor's lawn when he was in high school. Then he got out of high school and went to college. And guess who started mowing the lawn after that? I did. And she would pay me. And then one year I made too much money and she had to give me a 1099 because I made over $600 mowing my neighbor's lawn. And they apologized for it. And I'm like, hey, it's the rules. It's no big deal, but that happens. And so if you have somebody working for you that makes over $600, technically you should be giving them a 1099. So 1099S, SA, 1099Q, 1099K. Uh, 529 plans. So if you put money into a 529 plan or maybe another educational plan where you've put money in, you get tax favored treatment and you use that money for tuition, that would get reported on a 1099.
Yeah.
And of course, I don't think we have one up. Did we put 1099 SSA?
No,
so that's your 1099 from Social Security benefits. That will have all of that on there.
Some people,
all that
we didn't touch on this, but K1, some people get K1s distributions. So
those other 1099s are so, they're just not common. They're just not common. Most people are not going to get those. Okay. So W-2 wages. Now, this is really important too to point out is that this particular person, and this is not Adam Smith, our tax adjuster. This is just a made up name. So in this particular situation, we're looking at somebody has gross income of $65,000, but they're putting $6,500 into a 401k. A 401k contribution Before tax is an above the line deduction. And so that shows up on the W-2 where they have their gross income and then they actually have, minus the $6,500 and it determines how much tax is being paid. And you can see the federal withholding, the state, Social Security withholding, and Medicare tax withholding. So it's important to know in a 401k, if you're putting money in a 401k, you're not paying federal income tax on that, but you're still paying Social Security tax.
I think this is me. Yeah. Okay. So next we're going to move from the income side to how it's actually taxed and get into some of the deductions and credits. And again, we're going to go through just another scenario just to explain all this. And this is going to be a younger couple, Jim and Jan, 2 children under the age of 18, which is an important distinction. And just say one of the kids is in daycare, which is another kind of important distinction as well too. So the couple has combined W-2 income of $118,000, interest income $450, just taking the standard deduction for them. They'll get the 2 child tax credits of $4,400 or $2,200 per child. And then they'll get the dependent care credit of $500. So here's where everything flows through for this particular couple. They got their W-2 income, $118,000. And then here we've got standard deduction. Well, I should say 11B is just all their income was really, it was their W-2 plus the interest income. So that's where their adjusted gross income falls. Their standard deduction, and then here's where we get into line 15, your taxable income, and then we get into some of our credits. So here is the total tax liability based on the $8,600 or $86,000, et cetera, of how much tax they would be entitled to pay. But this particular couple, like we talked about, has 2 children and 1 in daycare. So we go down here and then we see, okay, they're going to get $4,900 of tax credits. Again, that's $4,400 for the child tax credit, then the $500 for dependent care tax credit. So that brings down their total tax liability to $5,057. So it's the total tax owed before credits minus the credits gets us to that final number. So instead of having to pay that, they actually get entitled to this. And so this is just, we want to highlight the importance of tax credits and just say credits are more powerful than deductions. A deduction is a reduction of income. A credit is a reduction of tax liability owed. So again, a deduction is, it deducts income. A credit is a reduction of tax liability owed. So
does everybody understand that concept pretty well? With tax credits, really, really, really important to understand the distinction between that tax deduction and a tax credit. Very important.
Yeah. So credits are just a really, really powerful thing for folks who are entitled to certain ones. And so here we just get to their, so here we go. Total payments, they had W-2, well, they withheld $14,160 from their W-2. And so this particular couple would be entitled to a pretty massive refund. So in a scenario like this, we would come back to them and say, hey, you've been withholding, say, $14,000 from your W-2 or for your paychecks. We should maybe cut that back because at the end of the day, we don't necessarily always love a huge refund. We'd rather you keep that money throughout your year. So just a quick planning scenario for a couple. And I won't spend a whole lot of time on these next 2 slides, but what's just important to understand is that based on your modified adjusted gross income, so MAGI, that is the number that drives, and we talked about so many other, the ability to qualify for deductions and to qualify for credits. So that modified adjusted gross income number is very important. There's a lot of different things, deductions, credits, phase outs that we have to be aware of. So that modified adjusted gross income number drives that. So, and then here we go with just a few other ones. Roth IRA contribution, that's one that's usually pretty important and that we pay attention to. The net investment income tax, all important things that just depending on where your income is going to be able to drive if you qualify or not. So
common tax credits that you'll see, we have them listed up here. And there's here it's important to distinction between refundable tax credits and non-refundable tax credit. A refundable tax credit, like these top 3 here, earned income tax credit, child tax credit, American Opportunity Credit. Because after you fill your full tax bill, and let's say you owed $2,000, And then you had some tax credits that would decrease that $2,000 tax liability to below zero, to a negative number. So let me just use a quick math. You owed $2,000 in tax, and then you applied your tax credits, and let's say you got $5,000 of tax credits. So that took your tax liability from a positive 2,000 to a minus 3,000. A refundable tax credit means that you get a tax refund of $3,000. So you get refunded on tax that you never paid. That is a refundable tax credit, and it exists for a lot of people out there. Now, you got to be a fairly low incomer to get that. A non-refundable tax credit will just take your tax liability down to zero, and if it took it down below zero, you don't get that money back. So a refundable tax credit would actually get you a tax refund on income tax that you never paid. And those top three are examples. The bottom three: premium tax credit, adoption tax credit, fuel tax credit, energy credits are non-refundable tax credits. So again, I don't think anybody in this room probably gets any of those, but I guess you never know.
Mostly for younger families.
I suppose the fuel tax credits and energy credits you could, but some of those are going away too. And off the top of my head, like there's a few like EV tax credits or solar panel tax credits that I think are being phased out. So standard deductions. We briefly touched about this. It's just a chart that will show you both 2025 and 2026 standard deductions. So this is for the people who do not itemize their deductions. So if you're taking the standard deduction, you'll see the single filers and the married filers, head of household, married filing separately. And those standard deductions have gone up. The one thing about if you're over 65, you get an extra standard deduction. I believe it's $1,650 per person in the household that is over 65. And as I say that, I'm going to go look. Yeah, it is $1,650. So for over 65. Oh yeah, we
and a
even
single
have that.
filer.
We even have that. Or blind people.
Single filers 20
is 2,000.
Just 2,000. Yeah.
It's on the tax planning sheet. And if you want to look for your extra deduction, it's 2,050 there. So on the tax planning sheet where we have the tax rates, it's over on the right-hand column, about halfway down where it says standard deductions. Everybody see where I'm at? So married couple, single, head of household, and then the extra standard deduction for age 65 or blind. So that married couple filing joint, sometimes it gets confusing. That 1,650 is per person. So, if you're a married couple and you're both over 65, you get that times 2. And then the single filer only gets the $2,050 extra off the standard deduction. So this is if you're not itemizing. It's important to know that. So still important to go through your itemized deductions. In fact, I did my mother's taxes here a couple of weeks ago, and I have tax software, and they make me jump through all the steps to see if she could itemize her deductions. I already know she's not going to itemize, but me being the type of numbers guy, I put it in there anyway just to make sure. So itemized deductions, mortgage interest, up to $750,000. You talking about SALT later on? State and local taxes.
Just talk about the new law.
Yeah, the new law, state and local taxes. So your state income taxes are deductible off your federal income tax. Again, you've heard me say again, the government has always been pretty good about not taxing income twice. That's why you get to take your state income tax, your property tax, your local income taxes off of your federal tax income so that you're not paying tax twice on that income. What's that? Health expenses over 7.5% of your adjusted gross income. Again, that's another one that Max just made mention. There's a SALT deduction.
I just point out that where we see a lot of value or for folks itemizing would be people who are in like nursing homes or need a lot of care at the end of life. A lot of those people have just massive healthcare expenses that all of a sudden they are itemizing, and their itemized deductions are pretty big. So that brings down their income quite a bit because of those healthcare expenses.
Excellent point. Excellent point. And sometimes you could be in an assisted living facility where not 100% of your care is deductible, but a portion of it is. And so the assisted living facility should be able to distinguish out of all the money you paid them, how much it would be considered healthcare versus how much would be standard living. Charitable contributions up to 60% of adjusted gross income. That's per charity. I believe, right? Yeah. So you can't give like your entire income away to one charity and expect to be able to deduct it all. You're limited on how much you can give to a single charity out of your income. And certain types of losses, i.e., gambling losses.
Okay.
So here, and we're not trying to be political. This is just the name of the bill that it's named everywhere. We go to organizations and they always talk about the One Big Beautiful Act, One Big Beautiful Bill Act. So here are some of the parts of the new tax laws that went in, the new deductions. So if you're over 65, you get an extra $6,000 per person. And this is whether you itemize your deductions or take your standard deduction. So this is where they said no tax on Social Security. This is a way that they're attempting to get rid of tax on Social Security by giving you, a married couple filing jointly, an extra $12,000 deduction, single person extra $6,000. Now that does get phased out if you make too much money. If you're a married couple making over 150,000, you'll only get a portion of that. And it goes up to 250,000. And if you're making over $250,000 a year, you do not get this deduction at all.
And it's on the tax planning 2026 tax planning sheet there too. You can kind of see those phase outs. The name we're calling, or a lot of people are calling it, is an enhanced senior deduction. So probably one of the more important provisions of the new tax law. So Tim brought it up, SALT deductions for people who do itemize. So there was a big change. So when the Tax Cuts and Jobs Act was enacted in 2018, they limited SALT tax to $10,000. So for people around here, maybe not as big of a deal. You think people in bigger states with high state and local or property taxes, it was a big deal because all of a sudden their itemized deduction went up from way up here. Now they're capped at 10,000. So what the new law says is that it goes up from $10,000 to $40,000 as the new cap that you can deduct for an itemizer. But that's only going up till 2029 with a 1% increase every year. However, I guess we'll touch on the next slide quick, but that number goes back down to 10,000 for folks who are in the 37% tax bracket. So that very highest tax bracket. But for people who do have high state, local taxes, property taxes, it is a nice ability to be able to go up to 40,000 now. So.
New thing for 2026 is charitable deductions for non-itemizers. So before, to take a charitable contribution off, you had to itemize. Starting in 2026, taxpayers can take the standard deduction and then also take another $1,000 deduction for charitable contributions. And again, this is $1,000 per person. So if you're single, you get $1,000. If you're married filing jointly, then you each get to take $1,000 for charitable contributions. If you were here last month, I said that the law went into effect in 2025. It does not. It goes into effect in 2026. So I don't know if anybody caught that at all. Probably not. But anyway, 2026 is the first year you can do that.
A couple other big ones, tax deduction for tips, tax deduction for overtime. So they both have phase out limits and they both have the same phase out. So if your income for an individual exceeds $150,000, you no longer get the deduction. But for tax on tips, you get a deduction for $25,000. So there's actually a new line on the tax return that shows income associated with tips, and that's how they distinguish what that tip income looks like. And then tax deduction on overtime. So that is literally just if you say you get paid time and a half, it's just the 0.5 associated with the overtime pay. That's what is associated with the deduction for overtime. And we were just like at a return this morning for a gentleman who did get a nice deduction for the overtime. So those are going to be, I think, pretty nice deductions for kind of that lower to middle income range folks, especially who are maybe putting in a lot of hours or, the service type worker people. So those are the deductions on tips and overtime.
And it is important to point out that a lot of these go away for high incomers. These are only for the lower incomers. And we say lower income, 150, 250,000, a lot of these get phased out on. So,
yep.
Okay, this is the reduced federal income tax rates extended permanently. And we always say permanently and write it in pencil because it's only as good until the politicians want to change it again. So when the tax rates were changed way back when, they were supposed to phase out here. It was at the end of 24?
Into 26.
Into 26.
25.
25 and change. But anyway, they put these new tax rates that you see on that tax planning sheet there is supposed to be permanent now.
But I will say is like this is probably one of the most overlooked things because it was going to phase out and virtually everybody would have gotten a tax hike
Yeah.
if we would have gone back to 2017 and before pre-Tax Cuts and Jobs Act. All but basically a little bit of range would have gotten a tax hike. So this is one of the most important probably aspects of it, just that we made these quote unquote permanent.
Because when they put these rates in, they added the 10% rate in and added the 12. Before that, it went from 0 to 15 to 24 or 25. So they added a couple of the lower tax rates in there. State and gift tax.
I guess we'll touch on this a little bit more the next slide, but a state and gift tax, this was made permanent. So this just means for, I think we maybe have another full slide on it. Yeah, we do. So just we'll touch on that here in a little bit more. But for a single filer, that means you can have a $15 million estate and not owe any estate tax. For a married couple, that goes up to $30 million, and then that's going to be indexed. So it's not something that's going to affect most people. QBI, I guess, is
20% QBI income tax deduction. This is mostly for self-employed people or small businesses that maybe have an S corp or an LLC, where income passes through to the business owner's tax return. So they're not filing a business tax return. This is pass-through income. So this gives small businesses a little extra tax deduction. So because a lot of small businesses may show some high income and it bumps them up pretty fast when they have a lot of expenses. So they give them a little bit of extra expense to make it a little bit more comparable to maybe a C corp. So
standard deduction increase just pretty modest, but we did see that go up a little bit for individuals, married couples. The child tax credit, that was made permanent to an increase of from $2,000 to $2,200. So a nice thing for folks with kids and who do qualify. The Trump accounts, which is kind of coming to the news now just because you can finally start to get enrolled. So this is going to be for people 18 and under who can qualify for this. I guess the most important thing is that for kids born in 25, 26, 27 to 28, so over the next, last year, the next 3 years, they'll get an additional $1,000, potentially $1,250 seed investment from the government into those accounts. So it can be a nice thing just to get, kids' feet wet or get some money growing and compounding. And there's a lot of rules around that, but it can be a nice thing for kids who are going to be born. And technically, parents, grandparents, whomever can contribute an additional $5,000 a year to those accounts as well too. They're not a deduction for parents, grandparents, et cetera, but it's just a way to get more money in there, and it just allow that to continue growing.
And by the way, that seed money that the government's going to put in, that was actually contributed by Michael Dell Corporation. They contributed.
Well, the 250 was.
Oh, yeah, a portion of it is, yeah. I mean, they put a lot of money into that for that seed money too. Yep. So
there are a lot of restrictions. Yeah, to get into the weeds, it's kind of technically going to be, it's going to technically be kind of an IRA for a child. And it's goofy because the money that goes in, there's no deduction. So you're going to have after-tax money and then, before tax and after-tax money in it. So it can create some complications. But the nuts of it is that it will be basically an IRA, but there are going to be exemptions to get money out of there penalty-free. There's still going to be taxes if a child takes it out before 59 and a half, just like an IRA, but there's going to be exemptions for first-time home purchase or qualified education, things like that.
It's going to take some really, really good software to keep track of all of that.
Yes.
So principal versus earnings and things like that. So
the final, I touched on this on the last slide, but just for those folks who are in the 37, the highest percent tax bracket, their item or SALT deductions go down to $10,000. So they don't get the full 40,000.
Again, this is just a reprint of our tax rates on your 2026 planning guide. So you can take those with you. And again, when you find your taxable income on line 15, this is the way you figure out what effective tax rate you're in, or excuse me, what marginal tax rate you're in. Find your line 15 from your tax return, plot it in here, and that will tell you what your marginal tax rate is. Oh, back that up one more time. I know you may all know this, but if you get up to the 24% tax bracket, again, it's only 24% on those amounts over that. Everybody pays 0% on their first amount, itemized deductions or standard deduction, and then 10% on your first 24,000 married filing jointly, 12,400 single, 12% on that. So it's not like, people used to talk about this word bracket creep and say, well, I don't want to make more money because then I'll just have to pay more in taxes. Well, you're only paying more in taxes on those levels above that income. So if you made $211,402 of taxable income, you're only paying 24% on that $1. Does everybody know that, this progressive tax rate? I know I repeat that. I just want people to understand that. Just because you're in 24% tax bracket doesn't mean you pay 24% on everything back to 0-1. In a few slides, Max is going to talk about an effective rate versus an average rate, and it's an important concept to understand. And then there's the capital gains tax rates as well. So, and capital gains and qualified dividends tax rates.
So this is just touching on the estate and gift tax numbers again. Not something that applies to the vast majority of people, just the very, very wealthy people. But to put it short, for a single person, if you have a $15 million estate, so basically everything you own, if it's 15 million or below, you won't pay any estate tax. Or if you give it during your lifetime, that's called a gift tax. So that total number estate, or during your lifetime gift, or at your death estate, that number is $15 million. If you have that estate below that, it's excluded. For a married couple, that doubles to $30,000. But if you are somebody who, $30 million, $30 million. But if you are somebody who has an estate over those amounts, any dollar over that amount is taxed at 40% from the federal side. And then some states do have inheritance or estate taxes as well too. So important to know. And of course, really, really wealthy people do things like have very complex trusts and stuff to try to get away from some of this, because that is a pretty high number. But there is an annual gift tax exclusion. I think a lot of you are probably aware of that too, is that it's $19,000 per donor per person. So again, that's gift and estate tax is not something the vast majority of people have to be concerned about. But there is an exclusion, which just means you can give away $19,000 per donor per person. And what would happen is that it would not require you to file a gift tax return. If you give somebody over that amount, say you gave somebody $100,000, you would have $81,000 you would have to file on a gift tax return that just reduces your $15 million by 81,000. So just something to.
It's a way the government keeps track by making you file that gift tax return, even though there's no gift tax due.
Right.
They need to keep track of how much money you're giving away in your lifetime, and it just reduces that 15 million down. But that 19,000 a year doesn't count. So that 19,000 a year doesn't eat into that 15 million. It's important to remember that.
Per year.
Per year.
Per year.
Correct.
And it is indexed too.
Now let's pretend you're a married couple and you're nowhere close to even worth $30 million and one of you passes away. Should your attorney file an estate tax return when you die? And a lot of people go, I'm worth $1 million. I'm worth $2 million. That we're not even close to $30 million. Why should the attorney file an estate tax return when the first person of a married couple passes away? Well, the reason is that you get to claim their 15 million if they never use it. So a married couple, we said, has $30 million, 15 million per person. Well, when one person dies, that 15 million doesn't just go away. The surviving spouse can claim that 15 million as well. So that surviving spouse now can keep a $30 million estate and not pay any estate tax. Are you with me so far? Okay. If you don't file an estate tax return, you just let that 15 million go away. Now, a lot of people might think, well, what does it matter? I'm still not even worth $15 million. Well, what if on a whim you go buy a Powerball ticket and you win millions and millions of dollars? What if one of your stocks in your portfolio just goes hog wild over the course of a few years and now you're worth more than $15 million? There's all sorts of reasons why you should go ahead and file that estate tax return when the first one passes away. And I think the statute of limitations, you know that, 3 years. Maybe after the first one passes away that you got to do it. And if you don't do it, then you've lost it forever. It could be 2 years. But don't let your tax person or your estate attorney talk you out of not filing the estate tax return. I'm telling you, just have them do it. It's not very expensive. There's no estate tax that's going to be due, but it is a way that you can claim that $15 million from your deceased spouse. And it's a just in case. It's a just in case. You never know what happens with your income in the future.
Marginal versus effective. So we've hit on it a lot, but marginal again, that's where you fit in on that schedule as far as what's my taxable income, what's my marginal tax rate, meaning the next dollar of income I have is going to be taxed at that marginal rate, which is the numbers that we all associate with all the time, the 10 to 37%. Tim talked about that. That's a progressive tax system. So, lower income, and then it gets taxed, of course, higher as you go above. But then there is a term effective, which differs actually from average tax rate, but effective tax rate looks at, well, should take a step back. We kind of misspoke on this a little bit. So effective tax rate would be total tax liability divided by your taxable income. So what you see on in your tax brackets there, the average tax rate is just total tax liability divided by total income. So, but speaking of effective, that's again total tax liability divided by taxable income, which is should be a much lower number. So, I like to prioritize, or I think it can be more important to look at effective and average tax rates versus marginal, just because it shows a little bit more accurate of like, okay, how much tax am I actually paying, depending on my total income. So,
because you may be in the 24% tax bracket, but your effective tax rate bracket's going to be down into the teens. It's going to be much lower than your marginal rate. So if you're in the 24% bracket, but because of all your deductions and everything like that, you're not paying 24% on all your income. And then because it's a progressive tax, some of your income's at 0, some's at 10, some's at 12, some's at 22. We take that all into consideration to figure out what your effective tax rate is. Every time if you have a professional do your tax return, they will probably show you on your page, it shows what is your effective tax rate.
okay, that's all we had for you guys today, and I know we're a little bit over.
Not as bad as the last couple months. So does anybody have any questions? We were that thorough, weren't we? In the end, I'm going to say just in closing is that, a lot of people say taxes are what they are. But again, we go over and over again. You should always want to pay tax at your lowest possible rate. And it's just something, just don't ignore it. Just don't say, yeah, we get to the end is what I owe and be done with it. We want to be tax efficient as possible.
Yeah. And we want to tax plan, not just tax prepare. The difference there is that preparation just means gathering up all my forms, file my tax return. Okay, here's what I owe, here's what I get back. Tax planning looks at what are things going to look like in the future. Maybe this year, maybe it's 5-10 years down the road. Try to be proactive rather than just reactive. So
we don't want to be caught, by surprise when we turn 73 or 75 later on, when you have to do something or you inherit money or you have to take money out of your IRA. So sometimes we say, yeah, you don't have to take money out of your IRA, but maybe you should if you can get taxed at 12%. So anyway, that's what we're trying to do when we do tax planning. We appreciate you coming. And next month, by the way, we are talking about Social Security. Max and I are not presenting. We're having Phil Phillips. He's a former Social Security administrator in Carroll for several decades, as a matter of fact. He's going to be our presenter, and that guy knows a lot about Social Security. So it might be, if you're already on it, it might still be interesting. And if you have people that are approaching that 65 or 67 or 70 years age and they're thinking about taking it, it would be a good one for them to be on as well. So, and then if we're looking clear out to May, we're doing a cybersecurity one about what you can do to protect yourself from cybersecurity crimes. Anyway, that's it. Thank you very much.
Thank you.